everyone, to the first quarter of 2024 market commentary. On this call, we will highlight our published market commentary, which is a review of the prior quarter, so the fourth quarter of 2023, as well as the prior year. And we will also outline some of the things that we think might happen this year, some of the portfolio positioning things, the economic things, and just our general thoughts on the economy. Before we go too far, I have to remind everyone that the views expressed on this call and in our brief that is now published on our website are always to be made in the context of a well-diversified portfolio and should not be taken as a recommendation to buy in or sell out of a particular area of the market or a stock. If we mention a stock on this call, that does not mean that we are recommending to buy or sell that stock. That is purely just commentary. Our views on all of these topics can and will change as new information becomes available, and we will, on a quarterly basis, update this briefing to all of our listeners to keep everybody informed of changes in the market. Hao, thanks so much for joining me today and also for taking lead on our commentary. Why don't we start off here with the year in review? So 2023 was a volatile year, but ultimately a pretty good year in markets. And kick us off. What happened last year? How did markets perform? And what's your insights?
Yeah, heading into 2023, it was basically felt like an extension of 2022, which is a really bad year, right? It was volatile and it ended up pretty bad. Yeah, 2022 was down 19%, and we expected more of the same. We, meaning the broad institutional investor class, I guess, expected a repeat because things weren't improving. Inflation was high and interest rates are going up, right? We had a hike cycle that started in March 22 and ended in July 23, and that was a total of 11 hikes. And our interest rates, federal funds rate, went from 0.08% all the way up to 5.33% in a matter of like 16 months. That's a really fast hike cycle. And when you
fastest on record?
We think so. I'll have to go back and double check, but it's one of the more historically fast hike cycles that we've lived through. And when you hike interest rates that fast, things slow down, right? Businesses start slowing down business. People borrow less because it's so expensive to borrow, right? Buy less cars, homes, things like that. At least that's what the thought was. And you would expect in a recession when people slow down purchasing like that. And what you didn't get was a recession. You also didn't get a slowdown in purchasing. You didn't get a slowdown really in anything. And it turned out to be pretty good. Inflation still went down, even with the lack of slowdown in demand and buying. And I think that was really important for the Fed to see, where inflation kind of resolved itself, right? And supply chains improved, but inflation is still sticking to other places. But we've seen a massive improvement in inflation, and I think that was something to be applauded. Whether it was the Fed's responsibility or not, it was something that's pretty amazing that the U.S. economy lived through.
Yeah, I think we can definitely credit the Fed on some of that. I know you're going to talk about this in a moment, but mid-size and small-size companies in the U.S. consistently reported in earnings last year that one of their largest growing expenses was interest cost. So many of these companies use debt to finance their operations, and the cost of that went up, which of course put downward pressure on their profitability and actually held down those stocks for a good amount of the year. So there certainly was some slowing effect to economic growth that the Fed did in fact deploy last year.
But the consumer saved us. So our collective spending kind of not only overshadowed that or counterbalanced that, it outweighed it. And I think that was, maybe a positive thing. We won't know for sure, but yeah, it was positive.
Yeah, very good point. Yeah, consumers kept buying. Maybe corporate profitability for small and mid-sized companies came down a little bit because of that, but consumers kept buying their products.
Yeah.
Do you want to highlight here for a moment just some of the different asset classes, some of the winners, some of the losers in 2022, and then how they did in 2023?
Yeah, almost everyone was a loser except for oil and energy in 22, and it almost like a mirror image. Everyone was clawed back their losses, if not improved. Outside of energy, energy was up 39% in 2022 and 0 in 2023. And China was down negative 22 in 22 and negative 11 in 23. But everyone else, whatever they lost, they seem to recover at least some or if not all of what was lost in the last year. So we saw this clawback effect happening on top of the global, not global, but U.S. GDP improvements that we've experienced.
So I think in sum, what I heard there is returns last year were generally very, very good. But if we look at just last year in a vacuum, that's not the accurate picture. We have to go back to beginning of 2022. So really, it's a 2-year history to see where asset classes have gone over that period, since 2022 was down for a good majority of the year.
If you held the S&P for 2 straight years, you were up a net of 9%, and that was a pretty rocky ride. But you're still better off for it.
Sure.
U.S. large cap, you're net up 4% over 2 years. So these are single digit returns, and we basically round tripped over the last 2 years.
You talk a little bit about this in your post about the catch-up rally. What do you mean by that?
Yeah, all year we've been talking about the Magnificent Seven really leading the charge. That really broadened out in November, December last year. If you look at small cap and mid cap performance, they ended the year 19% up and 17% up respectively. But the story really was not the year-end figure. It was the close of the year, where starting November, small caps were up over 24% in 2 months. Mid cap was up over 18% in 2 months. The S&P, for its part, it was up 13%. So small cap outpaced the S&P in an 8-week period, right, by 11%, which is just a not a concentrated rally, but a very healthy rally for smaller companies.
It's actually impressive because the S&P 500, of course, is the 500 largest companies in the U.S. Your proxy here for small cap is the Russell 2000, which would be the 2,000 smallest companies in the U.S. So 2,000 companies went up 11% more than 500 collectively. Yeah, that's impressive.
Yeah.
And considering 2,000 companies in index, that's a very, very small weight in each company.
Yeah. And we point that out because people were ready to throw in the towel for smaller companies, right? Anyone who wasn't Magnificent Seven, they were lagging, they were frustrated all year. And that shows you that you should own lots of different things, because things like this do happen.
And do you think that was due to the Fed signaling that they would actually drop rates in 2024?
It coincided with it.
Coincided with it?
Yeah. Jay Powell came out and said, we're going to cut rates 3 times next year. That remains to be seen. We have not seen any rate cuts yet, but the market is opportunistic and sometimes over-optimistic and really prices that in right away. And the perception there is smaller and mid-cap companies are more reliant on interest rates, meaning they borrow more. Which, again,
kind of related to that.
Yeah, a pretty fuzzy line, but that's what the market optimism is looking at.
Got it. Let's shift over to inflation. I think there was good news there all year. And then wage growth. I think there was also pretty good news there all year.
Yeah, we ended the year at 3.1% inflation. I'm talking core inflation. So if you include gas and food, the inflation rate is actually lower than 3.1%. So we're looking at pretty good improvement in terms of the inflation figure. Wage growth had been a piece of it, where the more you have to pay your employees, the more you have to price your product, right? So for a time there, for nearly 2 years, inflation had outpaced wage growth. So if you got a raise, well, here you go with higher prices, right? So you erased all of the gains that you made from your salary until recently, right? So in, I would say March of last year, we started to see inflation go below wage growth. So people are actually finally getting ahead. And I think that has a lot to do with market sentiment. Or consumer sentiment, sorry.
Yeah, and that's an interesting point. So this chart here shows that inflation went below wage growth in roughly March or so. I'm sure that March wasn't like the switch that went off, that people started
Correct.
feeling that, because I think, gas prices came down, which is a big component. I know for me, when I fill up at the pump, if it's more than $100, it's like, whoa. And it was there for a while. So, now I just don't fill up on empty, and it makes me feel better. But,
fill up more
if
frequently.
the gas the price, to fill up, half tank, it makes me feel like it's super affordable. But I think that really does. If more of your paycheck is going to gas, it's like, oh geez, gas was this. Let's eat in tonight. And so I think spending changes. So, but the crux of the matter is that inflation largely is lower than wage growth right now. So people are likely feeling like they're getting ahead, which probably buoyed the consumer sentiment figures towards the end of the year.
Yeah, and Chris and I have pointed to this several times, but we just couldn't figure why the market felt so good and real life felt so crummy. And I think this was a big component of it. What drove consumer sentiment off a cliff, which, to be clear, it's improved, but it's nowhere near pre-pandemic highs, right? We're still about 30% off, where our low was about 50% off its highs. So consumer sentiment has a ways to go. As a reminder, what the University of Michigan asks are what the perceptions of current economic climates are, right? I don't know how many people they survey, but it is a lot. How do they feel about the state of the economy, like their job security, income level, economic stability? I think that's one big question. Expectations. Well, how does that look in 6 months? Your job stability, your ability to get a raise, personal financial situation.
Sorry, I want to just interrupt you just for a second. So you're going over the questions that are asked to calculate consumer confidence, right?
Yes, in a broad sense. Like, this is what they ask people, and they'll say, hey, this person feels good or not, right? And then they pull those.
Yeah, okay. So this is how that metric
together.
Is built on a monthly basis based on responses to these questions. Okay, carry on, sorry.
Exactly. And ideally, you want to ask the same people month in, month out, right? Because their moods will change. The next part is personal, like feelings about their income and debt levels, like how much they're underwater, if not any. Do they feel financially secure? Can they pay their bills? I think that's such a big component, right? Like, if you're not feeling great about paying utility bills, you're not going to feel good about, no matter how good the economy is. And I think that really gets down to the crux of how people feel versus what the markets respond with, right? Are you feeling confident on your discretionary purchases, right? Do you have to cut back so much because the price of eggs are draining your savings account, right? You got to cut back on Doritos. You got to go to the white label brand, right? And then future purchasing plans.
Okay. Breaking news: the eggs I buy are back up 50 cents. I'm pretty mad about it. I gotta say, I was just at this, and they keep selling out of them. We buy this 18 packs. We eat a lot of eggs, and they're up 50 cents now, and I'm just like, really?
Yeah, and the eggs we buy are pretty cheap relative to where in the summer. So maybe it's a state thing. But
you just got to get into the the pasture raised classical music sung to eggs that I buy. Those are the ones. Vital Farms. I should own the stock. That's not a recommendation, but
let us know if the egg topic really bugs you, because most of our clients are Washington. So I might be downplaying the price of eggs for everyone. Yeah,
I am definitely a proxy. I'll definitely speak to that.
Yeah. All right, back to the consumer sentiment. Last section is future purchasing plan. So, like, are you going to buy a car if you feel kind of iffy about your job? Right? Are you going to sign up for a new car loan? Like, they all kind of feed into each other, and they all form this consumer sentiment score at the end of it, and that's basically what's being asked.
Got it. Okay, so current economic conditions, how do you feel? Personal financial situations, how do you feel? And then future purchasing plans, basically, are you planning on doing anything? And based on that range of questions, sort of some sort of a number is struck, and then that's how this is charted. And what you're saying is that consumer sentiment has improved really throughout the entire year, actually since about the middle of 2022, but it's improved, and that could also be pointed to the fact that inflation has been coming down since the middle of 2022, right? So as things have been getting cheaper on a relative basis, people are feeling better and better about their incomes and their ability to spend.
Yeah, and if you were point to one thing, it's probably gas prices rather than eggs, because it's a daily reminder of how, you perceive things to be cheaper or expensive.
Yeah, totally. Okay, let's shift to our outlook.
Yeah, this year's stark difference. We started the year where 100% of economists said we were entering recession in 23. Only 24% of them are saying recession is more likely than not this year. There's still a lot of uncertainty,
interesting.
though. Yeah, so
A few holdouts still.
Yeah, few are holding out. But I guess if you say the sky is falling enough, and when the sky finally does fall, you look like a genius. So it's they call for, they've correctly predicted 20 of the last 7 recessions correctly. Is that the term? But I think a broken clock is right at least twice a day, and that might be part of it. But again, if you're an investor, you should always be worried about volatility and potential drawdowns, because it's normal, but you just got to be mentally prepared for it. And I think that's what we're saying. Still, inflation has never cooled to the Fed target without a recession. So we've rewrote history here, and not to say recession doesn't happen, because there might be something that's unknown that we're not seeing that could still shake the markets. It always does. Even though economists tend to be wrong about predicting the future, they're predicting the future, right? How right, or 100% of the time, have you found someone to be a professional that they've called every single instance properly? That just doesn't happen. But you should still use them as a guide, right? So we're expecting a little bit slower growth, but slower growth. We're not expecting a blowout like 2023. But again, not a lot of people did either. And most people are still kind of keeping to that viewpoint.
Yeah, 2023 seemed to also be kind of an earnings recession, and so the anticipated earnings from companies was lower at the end of 2022 and throughout that year, just as stock prices had come down and economic outlook had sort of deteriorated. And then when sales were better than anticipated, that's in part what caused this big rally in 2023. And so that's what's referred to as an earnings recession.
Yeah.
So that, likely was also a component too. Let's shift to our last topic here, interest rates. I bet this is going to be our biggest thing we talk about in 2024. I feel like we talked about this a lot in 2023 too, but what do you think on rates? Just what is the Fed saying that they're going to do, and what are your insights here?
Yeah, and we're using this as a warning to avoid spending too much time on, getting that extra percent from your CD or your money market. You remember I-bonds, where they were the thing. We even said, hey, take a look at these. But interest rates move fast. So something as appealing as 5%, and it's suddenly paying 3.5% or 4%, I probably wouldn't fight over that extra 0.5%. It's not going to be worth it. We're already seeing banks, sell CDs that have a lot more call features and then have a steep drop-off after a year. So everyone knows rates are going down. Everyone knows that. The next big thing is mortgage rates. Typically, mortgage rates follow the U.S. 10-year Treasury rate, which is around 4%. Mortgage rates are around 6.5%. So the premium is historically higher than it normally is. A 4% U.S. Treasury rate, 10-year U.S. Treasury rate, typically implies a 5% mortgage rate, typically. So banks are currently still pricing in a premium spread. They could definitely improve the housing market by bringing that spread down to 5%. And I think that's a psychological impediment. Once we start seeing interest rates go down around 5%, I think the housing market will hopefully start to loosen up there. But yeah, right now we're in a year rates drive everything.
Yeah, I mean, for mortgage rates went from somewhere around 8 to somewhere around 6.5 now. That's a big change.
Yeah.
But you're saying sub 6 is kind of the guess, I guess, when
Yeah,
I think
total
things start
guess.
to pick up again. Mm-hmm.
But psychologically, 3% to 5 seems kind of doable. But housing prices, housing prices didn't really move. They went down a little bit, but they didn't really move with 9% or 8% mortgage rates.
Yep, totally. Well, we still have a shortage of houses here in the U.S., so that's not going away anytime soon. Okay, awesome. Hey, thank you so much, Hao, for your insights there and giving us some color on your written commentary here. And as a reminder, everyone, this commentary is on our website. If you go to consiliowealth.com, in the Insights tab, you'll be able to go down to the Market Commentary section. And if you click there, you'll see our most recent commentary as well as all the prior ones. The article will be posted there as well as the YouTube video, which of course will link you over to the podcast as well. So thanks everyone for tuning in today, and we hope that this was helpful.
Make it a great one.